big part of making money is not losing it. That is spot on.
And this is relevant to now with the AI boom starting to mimic the internet boom of 98, 99, 2000, which ended very badly.
Why'd you leave Barclays?
Oh, I think the atmosphere was getting toxic.
Have you experienced the investment universe change over the last 38 years or so? Hey guys, welcome to the Way of Wealth podcast. I don't have my usual colleague Prajesh with me. However, I've got someone far better. So we've got Chris Fredman, who's another colleague of mine. So we sit on the investment committee for our Sharia-compliant investment service. Chris will tell you a lot more about that. Chris is the chair of the investment committee. Okay, and we are incredibly fortunate to have someone of his caliber and experience with us to share his insights on this highly topical matter. Welcome. So, Chris, how are you doing today?
I'm doing excellent, thank you, Mars. Very much enjoying this. Very
Wonderful.
pleased to be here on this fascinating topic.
Fantastic. I think it'd be great to learn about your background, Chris. How long have you been in the industry? What have you been doing for the last 15 years?
And the rest.
I'm only kidding.
Okay. Yeah. Well, no, I've been in the industry for approaching 38 years. Yeah. So I started in the late 1980s.
Nice.
As an investment manager, but also as a mining analyst, because my original degree was in mining engineering, worked for a short time in that space.
Wow.
And came to the city as an analyst covering that area. And I've morphed over the years into a straight investment manager.
Nice.
Done various things, and then some 10 years ago, decided to focus on responsible investment as a broad term.
I'm stuck on the mining, Chris. Did you actually do any mining?
I did a small amount.
Yeah.
And then the industry was more or less closed down in a recession. So Point of Air Colliery in North Wales.
Fantastic. Was it a coal mine?
It was a coal mine, but I wasn't wielding a shovel.
Yeah.
I was a junior engineer.
Fantastic.
I was sinking a tunnel, trying to make sure it went in the right direction.
Were there any transferable skills into the investment management world?
Difficult. I think the engineering mindset is a good mindset to have in the investment world, because an engineering mindset is about seeking solutions to problems.
Yeah.
And it encourages a sort of a structured way of thinking, which I think is helpful.
Yeah.
So, because much about investments is creating structures that perform as you want them to perform.
Fantastic.
So I think that mindset helps.
Yeah, totally.
And I would say that engineers are generally decent people. So
I've come across a couple of engineers in the private client space as well, particularly when they're doing tax planning, setting up trust funds as well. So they've had a previous career in mining as well as engineering. And I find it fascinating in terms of, the way their brains work. They're very granular in looking at certain things. And I think that is incredibly important in the type of work that we do, because we're dealing with so many complex type of areas, whether it's tax, whether it's succession, whether it's investment management, whether it's post-death probate work. And you need to have a solid understanding of that entire landscape.
Yeah, so it's a systemic way of thinking.
Correct.
And quite often, in any engineering or financial situation, there are an awful lot of moving parts.
Yeah.
And you kind of have to know how those moving parts are going to respond in any particular situation and how they work together, how they interact.
Yeah.
Which is essentially what portfolio and investment management is about.
Fantastic.
There are certain things in your kit bag or toolkit, and you've got to work them all.
Nice. So over the last 38 years, what would you say at the height of your career? And it's only going higher now. But what is the most amount of wealth that you've managed?
It would be probably about 600 million, something like that.
Wow.
So that would have been running a team at Barclays.
Yeah.
And within that, I was probably responsible for about 100 million myself, and then managing all the others.
Fantastic.
So it was a chunky amount of money.
Why'd you leave Barclays?
Oh, I think the atmosphere was getting toxic.
Okay.
And I'd done some interesting things, some fun things.
Yeah.
It had been good to a point.
Yeah.
And then the business was transitioning into much more of a private banking role where you are selling products to clients and you're not managing investments for clients. And also I value the independence that we have at Peregrine. And, there's a structure obviously, but there's a good core of experience in the business without it being overarchingly structured.
Yeah, I resonate.
Because, so most of us who are directly facing on to clients and making decisions for them, actually, we want to act in the client's best interests.
Right, yeah.
And that, to some extent, explains the transition to responsible investment, because that's, to me, that's about managing people's investments the way they want them managed.
Yeah.
So without the client having to make the nitty-gritty decisions, but at least having much more overarching control over the way things are done.
Yeah.
And one of the analogies I draw on that is, if we all make choices about how we earn a living, and whether it's the right way of doing it, the wrong way of doing it, how that fits in with our moral compass.
Yeah.
And I don't understand why people have to throw all that away
Totally right.
when they're funding for their retirement.
Yeah.
Or for their children's future or whatever. I don't see why that disconnect should exist. It's silly and unnecessary. So I try, and for the last decade now, I've been trying to create portfolios that match people's values with how they make money.
Fantastic. So how do you see, or how have you experienced the investment universe change over the last 38 years or so?
Beyond recognition.
Yeah.
And when I started work, the only computer we had was a pocket calculator.
Wow.
So, you worked everything out by hand.
Yeah.
And if you were doing a letter, you wrote it out by hand and it went to generally a lady at a clunky old typewriter. And if you changed your mind after it had all been typed out, you got told off.
Superb.
So, so we've gone from that to... within a fairly short period of time, we had electronic trading. So you could pick up the phone, tap things into a board, and it would trade. And then we get the likes of Excel coming in, so you can set up valuation spreadsheets and all that sort of stuff, do calculations, big calculations quite quickly. And now we get to AI, where I can get it to do. It'll write the calculation for me. I don't even have to put it into Excel. Yeah. So the amount that you can process and the amount of information that you can gather is in a completely different world.
Totally. Yeah. How has that affected your job for the better? Yeah, there's something to be said about efficiency here, right? But let's say in terms of analyzing stock, okay? Trying to choose what type of stock or what type of asset class, what type of instrument security goes into your portfolio, okay? Does that or has that reduced the time taken? Has that reduced the number of stock you can actually, review now as opposed to 10, 15, 20, 25 years ago?
Yes, because the amount of information at your fingertips, and that's probably the nub of it, it's at your fingertips. Yeah. Whereas go back to pre-internet and big data and all that, you got to look at a company twice a year when it put its the half-year report and the annual report was pretty much all you had to go on. Yeah. And you had to read it and pull out the numbers you needed. And so very labour intensive and very difficult to follow a lot of stocks. Yeah. So if I wanted to filter, I don't know, for the supermarket industry, say for a particular, work out which one is the best to buy, that's an enormous manual process. Yeah. Whereas the data that I have now, I can filter through them on any number of metrics in minutes. Fantastic. And that may not be the final, it doesn't give me the final answer, but it certainly sweeps an awful lot of work away.
Brilliant. Yeah.
And the same is true of products such as ETFs
Yeah.
and mutual funds.
Yeah.
You can cover an awful lot of ground very quickly, which allows you to dig deeper into the things that really interest you.
Yeah. Okay, so what I've also seen, over the last 20 years or so, is there has been an increasing rise in the DIY investor space, because you've got a plethora of different platforms available where investors can literally go online and place a stock or purchase stock in a range of different geographies, within different types of tax wrappers. Okay, and they think, do you know what? If I can do it using best buy tables, all right, I know you're laughing, all right, using best buy tables and increasingly ChatGPT or Copilot or the plethora of other AI tools out there, why do I need someone like Mohammed? Or why do I need someone like Chris?
Okay, so we'll keep it simple and say, all right, in the press, private investors continually directed to buying ETFs.
Yeah.
They're apparently straightforward, cheap, simple.
Yeah.
That's what it says on the tin. But there are 7,000 to choose from.
Yeah.
Which one do you want?
Yeah.
Many of them are very concentrated, probably quite dangerous in the wrong hands.
Yeah.
So there are some very cheap, effective, overarching ones, All World Index, the FTSE, S&P 500. But once you get out of the mainstream, you can get yourself into a world of trouble if you don't understand what's in there.
Yeah.
So that is an area that's touted as being a great, safe, cheap place to be, perfect for the private investors doing it themselves. But it's full of pitfalls. Full of pitfalls.
Yeah.
The mutual fund industry, so it tends to be costlier. But again, you've got thousands to choose from. How do you do that?
Correct.
And then if we ramp up the risk a little bit more in the direct equity space, which is relevant at the moment because of the conversation around ISAs and how that might change to try and encourage people to buy shares in British companies.
Yeah.
But that again is the potential for mis-selling there is unlimited.
Yeah.
So I think there's still, and I haven't touched on the bit about risk management.
Yeah.
So how do you structure portfolios so it actually meets your objectives? Yeah. So the role of the advisor is manifold. There's all sorts of pieces in the puzzle that actually experience and knowledge can save you from a lot of harm.
I'd like to come on to risk management, but before we do, for the sake of our viewers, I want you to explain what you mean by concentration within an ETF.
Okay, so when an ETF is constructed, the constructors will say, right, they'll isolate a list of companies that they want to include in that ETF. And they will put some rules together as to how much goes into each company. And by and large, that will be dependent on how big the company is. Big company, big allocation. Little company, small allocation. And in a specialized ETF, you can find that the biggest company is a third of the fund, possibly even half the fund. That has happened. And so when you think you're buying an ETF that broadly represents technology, you think you're spreading your risk over lots of different companies. But in reality, half of what you're buying is one company that couldn't itself be extremely risky.
You know what I find hilarious as well, Chris? Okay, because I get the DIY investor coming to me every now and again. Okay, and I usually get the DIY investor who comes with me when they've got a huge tax bill, right? Or they're thinking about, look, Mohammed, I got a great business here, and I need to think about how I'm going to pass it down to the children and so forth. But I've been managing all of this money on the side, and I'm a fantastic investment manager. And then what I do, right? I go, all right, fine, okay. let me take a look at your portfolio statement, all right, and we'll compare it. Okay, we'll compare it with a professional manager's portfolio. Okay, and one of the things I say before I do that, I say, look, Okay. Have a bit of humility. Okay. Right. What you're saying is someone who dabbles in it is literally better than someone who spent decades in studying and practically investing, probably not only their money, but a lot of other people's money as well. And to date, I have not found a single DIY investor who's constructed their portfolio better than any professional.
Yeah.
Okay. I mean, even with me, okay. All right. So I may hold advanced qualifications in the investment space. Okay. I don't even manage my own money, Chris. I literally don't have time to. I don't have time to do all that stock picking, the analysis sort of stuff. Do you know what? Hand that over to somebody else.
Yeah.
Okay. At least I can be conversant with my investment manager, right?
Yeah.
I mean, that's the crucial thing. Now, if you've got somebody who is highly competent in this space, and they're choosing not to manage their own money, that should say one or two things, right? All right. So yeah. I mean, with this particular chat, we did have a really nice banter back and forth. Right? Having said that, okay, I think there's something to be said. If you've got that desire to literally play the market, right? There's no harm if it's not going to have an adverse effect on your overall wealth, okay? Have around 2-3% that you can play around with. Do whatever you want with that money, okay? But if I'm the wealth manager, we're going to have clear demarcation here in our terms of business. I'm not responsible for any of that nonsense, okay?
No, I think there are a couple of quite big ifs there, aren't there?
Yeah.
So the one is, I think investment management, like anything else, DIY.
Yeah.
Fixing your own bicycle, mending your own car, or whatever, or doing your plumbing.
Yeah, totally.
If you're prepared to learn how to do it, then why not?
Yeah,
but I'm not going to muck around pretending I know how to rewire my house.
Yeah, correct.
And so that's one. Then the other big if is that is the danger of confusing luck and skill in terms of making money.
Yeah.
Because a big part of making money is not losing it.
Correct.
And so if you like, the silent skill of
I want to
employing a
pause, Chris, here. I want the audience, all right, just to dwell on that. A big part of making money is not losing it. That is spot on. Sorry to interrupt the flow, Chris. Go ahead.
Yeah, so and there are a bunch of temptations that, if you like, the unskilled investor will have is to just follow momentum, follow the noise, just put more and more and more in. And then you're going to find, when you look at it, when the market turns against you, as it happens, frequently this happens, it's a cycle, and you have all your eggs in one basket and it goes wrong.
Yeah.
And you get destroyed.
Correct.
And this is relevant to now with the AI boom starting to mimic the internet boom of 98, 99, 2000, which ended very badly for lots of people who had forgotten to be diversified.
Yeah.
And the professional will have the skills and the supervision to ensure that the diversification rules are stuck to and that you don't end up all in the one spot that turns out to be the wrong spot.
Yeah.
And that's a crucial part of what we do.
Yeah.
So that if you employ an investment manager, they may not make you the most money that could have happened. They probably won't, because they'll have a mixture of investments.
Fantastic.
But they'll be focused on avoiding a real problem, but trying to get you to where you want to be. Yeah. That, I think, is a skill.
Yeah, superb.
That is probably forgotten.
Wonderful. Tell us about the Sharia-compliant investment space and what we're doing, Chris.
Okay. Well, the overlap with what I've been doing for the last 10 years in terms of sustainability and some faith-based investing was I was brought into the picture to say, okay, we have advisors that are skilled and interested and very knowledgeable on Islamic investment, but are looking for the right product for their clients.
Yeah.
And Graham, who's our CEO, said, okay, well, there's a distinct overlap between stewardship and faith.
Yep.
And let's see how I can pull that together.
Yeah.
Chris, you might be the right guy to do this. So our approach is, I think, slightly different to other people's, which is really just looking around the exclusions in investment, if you like, the strictures of investment rules, rather than and actually leaving out the spirit of stewardship of the world, which I think is possibly more important, but certainly works together with the hard rules around things.
Correct.
So that's how I get drawn into this area. I mean, I'm very comfortable with faith investing. I'm a person of faith.
Yeah.
And I think these things knit together very, very well.
Yeah.
So the direction in terms of our service is to actually be mindful of sustainability in a broad environmental and behavioral sense.
Yeah.
But at the same time, adopting the if you like, the hard rules around what's permissible and what's not permissible.
Yeah. Fantastic.
And indeed engaging in the discussion, because the hard rules are not always hard rules.